Good morning, everybody. Okay, um, we'll see how this goes on Spaces today. Looking forward to this. Get some bigger audience and some new listeners. And so we've had a busy week here and with Twitter and on the Twitter tweets and stuff about trend following. I think yesterday I tweeted about Paul Jones recommending trend following, and it was probably one of my most popular tweets ever. I get a lot of likes for Paul Jones tweets and Renaissance tweets, and it's pretty interesting what people like to see. But that was a pretty good, interesting video interview with him and him advocating for trend following. And I hope he's right. Of course, we had a big counter trend day yesterday in the currencies and the bonds and the stocks, and so right on time. One thing I saw on Twitter yesterday was someone was putting some stats out there talking about 2008, I think, when there was the last really big stock downtrend, and they were just sort of talking about some of the rallies and 3 and 4% up days followed by 3 and 4% down days, and I guess this kind of went on for a while. So you can just expect some of these trends to be very volatile, and I think that some of them recently have not been too bad. So we've had a good run of that so far. But we'll see what happens on that. And then my friend Mike and I were talking about gambling. Is trend following with an edge? Gambling, yes or no? That was this negative thing that Buffett was saying about everybody who doesn't do value, I guess, are a bunch of gamblers, and Wall Street is a casino. But I was just trying to make the point that some styles have more of an edge, a defined edge that which I think trend following does. So we can chat about that as well, and whatever else is on anyone's mind. Um, oh yeah, one other thing I wanted to mention was I tried to tweet about this week, and I didn't do a very good job of it. But I think it was something along the lines of I trade so many markets, and that's sort of one of the trend following strategies is to trade as many markets as possible, 50, 60, 100, 200, whatever you can trade, currencies, commodities, stocks, bonds, long and short. And then inevitably what pops up is, well, you're diversifying your every move you make, it's just going to be less money that you make, and you're kind of even if you get these outliers, you're not going to make that much money. Um, and then I was thinking about that and combining that with something I heard, I think, over the weekend. I'm not sure if it was on Rob's podcast, which I thoroughly enjoyed with Niels. That was another good podcast. Another thing to talk about. I like the part where they were kind of trying not to, but a little bit trashing PhDs at trend following firms that have 100 PhDs. But um, if you vol target and if you get rid of positions, based on volatility, these big uptrends, sometimes it can get kind of crazy, and the volatility can dramatically increase from when you put it on. You're kind of just minimizing the skew and the outlier trade, of course, in exchange for less volatility. I almost said risk. I caught myself. And then, but you're also. I remember this article that Mark, my friend Mark on Top Traders, he wrote, and other people have said too. That most of the time when CTAs make money, it's in a like the whole sector takes off. Like now, currencies are all short, or the interest rates, they're all short, and then commodities, they've been really great and stuff. And so I think that is the norm for most CTAs and traders who are really worried about volatility and cut back on those outlier trades. And of course, everyone benefits from these sectors going up all at the same time. But it is kind of a bummer when it reverses, because you don't have a lot of diversification. But I've made a lot of money recently in some trades that like Tesla. I mean, that could have made my entire year. You know, it could have, if nothing else would have happened in Tesla or Moderna. Um, you know, that would have just been fine for me for the entire year. And canola. And so there are trades out there. So I think if you don't really see that kind of crazy outlier capability with with all the volatility if you're continuing to reduce those positions. But I think that's kind of something where when we talk about trend following, some people don't really participate in those outlier moves. So they do think that trend following profits come from when the whole sector moves, and that's true for a lot of people. All right, who's next? Good morning, everyone.
Hi, Jerry. Can I
Good
ask you a
morning, Jerry.
question? Sorry, Richard. Can I ask you a question? I was thinking about what you just said and trying to backtest in my mind what happened in 2014 with the crude oil. If you were very, very diversified, like saying, for example, 200 instruments, I trade for 40 or 50, but if you have 200, wouldn't be that a miss in terms that that outlier wouldn't move much the needle, or do you think that also the whole sector would have compensate and add to have a good year, even if you have so many instruments?
Well, obviously, if you trade a lot more markets, you're going to reduce the size of each of the markets. So, like, I'll trade 5 units, whatever that means, in my own way of looking at things. And I'll just divide, if I have 100 markets, I'll divide the 5 units up with 100. If I trade 200, I'll divide it into 200. So you're right. In that particular year, okay, that particular year, I would have made less money in crude or energy. And so what would have that meant for me if I would have traded a lot more markets? Well, I don't know what other markets I would have traded, and I don't know how they did, but it could have been a situation where I had more diversification and I made the same amount of money because there were other markets that had nice trends as well. Or it just means that I would not have made that much money that particular year, but done better in other years by trading those additional markets. I know that I was listening to a podcast once, and I remember commenting on this on the podcast, saying it's where someone had said, for trend followers, it's 5 or 10 trades per year, 5 or 10 outlier trades. And I was thinking, no, it's 5%, so it's 5 or 10%, let's say. And of course, adding all these markets to your portfolio will make things in a robust way smooth out a bit without any compromise to your system. But you may have different performance than CTAs and trend followers who are more concentrated to 50 or 60 markets. The past couple of years, everything's worked pretty well. And then there have been a few of the markets within the sectors that have performed well that have done a lot better than some of the other ones. But I think overall, you should try to trade as many as possible and as many as you can, and not and diversify amongst the sectors as much as you are able to. But certainly your performance in any year could be a lot better or a lot worse relative to other traders, depending upon those particular market moves. So it's not written in stone. Over a long period of time, you're going to be better off trading more. In a short period of time, you may be lucky or unlucky.
Hi to everyone. We're happy to be here, as I always say, now in Twitter. So I want to say here that it's, of course, I fully agree that it's very important for all of us to diversify as much as we can and as much more markets as we can, and we always speak about this. But as I have said before, there is such a thing that I think we must not overweight a sector. So I think it's, for example, if we trade 200 markets, we must trade maybe 70 stocks, 70 commodities, and so on and so forth. I mean that maybe it must be equal weight between correlated return streams. I mean that if we have a lot of positions on stocks, and if we'll know that in all crises, all financials go to one. So I think that it's important for me personally. It's important to have to use common sense in this.
I guess that it also improves your sample size a lot, and that makes sense on its own. And I was the other day I published a chart by Chess Liberty about the power of diversification, and in that chart I thought that you can see what we are talking about, and there was a mention by Michael Harris saying a couple of things. One that I understood, and the other I didn't. Maybe someone can understand it better than me. He says that the backtest that Chess made was throughout many decades, and there was a change of regime shift in the markets, and that's something that Michael says a lot, especially since the 90s, which is something that can be debatable. But then he said something that I didn't understand. He said that with high serial correlation, the MAR ratio is a linear function of diversification, but with negative serial correlation, MAR it's a concave function. Anybody knows what that means? Because I mean, what he says is that since if there is a return to the mean or not serial correlation, being diversified is worse.
Look, the way I'd probably think of that is that I tend to think that divergent strategies have positive serial correlation. So they're targeting positive serial correlation, and under diversification, you improve your MAR ratio. But for convergent strategies that are targeting an equilibrium, you concentrate your strategy as opposed to diversify your strategy. So if you could imagine trading markets which are sort of oscillating about an equilibrium, convergence is a precise way of targeting that level of equilibrium. And if, for instance, you actively diversify your systems, that might actually impede your ability to target that oscillation. So we usually find that there's an antithesis between what trend followers do and what, say, mean reverters do. And I'd say diversification comes under this, because I think it's beneficial for trend followers to adopt diversification, but it actually might be counterproductive for convergent traders to adopt diversification.
Thanks, that makes sense.
Hey, what was the original question one more time?
No, the question was just the publication of a backtest in which what he did is he ran a couple of backtests selecting random instruments from a bag of 15 instruments, then, for example, 25 instruments, and then 50 instruments. And what what you notice in the chart is that when you select random instruments from a bigger bag, so to speak, the MAR ratio, the returns and the volatility improves a lot than when you are selecting from less populated bags of instruments. So that was just a statement, and when he saw it, he said, "Yeah, that's okay, but there are two issues. One is that there was a regime shift in the 90s, so now instruments are not autocorrelated, so there are more reverters, and thus, if you diversify, you are not improving your MAR ratio." That's what he said, and I think that he says that because he believes that trend following was very, very successful when there was a lot of retail traders that were soft hands, weak hands, and so trend following was getting money from them. That's I think his hypothesis overall. But it was just a statement, and he replied with that argument.
Where did serial correlation come in?
Because what he said is that up to the 90s, all instruments that you trade that were in the back test were autocorrelated. They were autocorrelated, and then from the 90s on, something happened in the market, and instruments become to lose that property, and that's why what he said. Why trend following had huge returns up to the 90s and not so huge returns up to from the 90s on. It's just an observation that he did, and what was pertaining to what we spoke about diversification. He says if your instruments are not being autocorrelated anymore, don't add more instruments. And then Richard said now, well, that makes sense if you are doing a reverse to the mean strategy, because if you want to achieve the equilibrium, then if you diversify, you won't do it. You have to concentrate more.
Yeah, I think an excellent example of serial correlation was, of course, in 2008, 2009, started in 2007, which really just means all the markets are correlated, converging together, and they're trending together. And I think serial correlation, when I hear that, I think of, it's actually caused by, the fact that the prices are going down 10, 15, 20, 25%, that more and more people are selling just because they're going down. And to me, that's what serial correlation is. I think as far as trend systems goes, if you have an entry and exit and size system that's got an edge and positive expectation, asymmetric, risk reward, then you just want as many markets coming at you as possible. You want as many trends to apply that to as possible, and that's where you use the word diversification. But I think of it as just much bigger sample size, and lots of different markets coming at you. And of course, the last 10 years, the stock market has primarily gone up in the U.S. and other countries haven't. Other markets haven't done as well until recently, commodities now. But, so a lot of people have taken their attention away from the international markets and all these other markets that trend really well because they haven't trended as well as, say, the stock market. So everybody got really stock-centric this last decade. And so, now I think, having that broader opportunity set is going to probably be a lot more important as it has been this year for everybody.
I like Mike, and I think he's a really smart guy, and he does a lot on Twitter. And he and I are friends on Twitter. Sometimes he loves trend following in me, and sometimes he likes to call attention to the problems with trend following as he sees it. The 1990s, I've said many times before, like the shorter term turtle trading systems were really short-term 40-day and 20-day breakouts. And I think that by our analysis, it sort of stopped working in the late 90s. And I think that sort of is a situation, maybe, I'm not going to speak for Mike, but he has a tendency to maybe dwell on that. Okay, so that's when trend following stopped working. Whatever you guys are doing now, longer term, of course, that's not the real great trend following that he does his own analysis. So he probably saw that same thing in the 90s. The markets changed a bit. And then, he also posted this, a good interview with Simons. And Simons is, and I tweeted this because it was pretty good, but, then he was sort of mentioning that Simons is also saying trend following doesn't work any longer. But then when you listen to the Simons tweet, interview, he sort of goes back to these 20-day breakouts, like this is their definition of trend following. If the 20-day breakout doesn't work, well, then trend following doesn't work any longer. Okay, that might be an overstatement, and I've tried to get Mike on the the Spaces and or Clubhouse, so maybe one of these days He's a really smart guy, so I'll need Richard and all you guys to back me up because I can't go toe to toe with Mike. But Mike Harris, okay, and so and then probably guys like that, Mike Harris and Simons, implicit probably in what they talk about too, of something working or not working, is inevitably probably going to be something about Sharpe. So I found no trouble just not paying attention to any of that because I want trend following to work, and it does work for me. And I don't care, we have had periods where it doesn't work, and we've experienced it, we've lived through it, and we've seen people write papers about it, and the conclusion is always the same. There have been no big trends. And so we gone through periods where there hasn't been outlier trades, and it probably didn't matter a great deal what kind of breakouts you were trading, what length, probably it was going to be difficult to make money because we have a methodology and a strategy that depends on large outlier trends. And as I've said before, that is perfectly, anyone can criticize that. Don't choose systems that rely on 5% of the trades to make all your money. I would never do that. That's the dumbest thing ever. Very valid point. Although our point is more valid because there has been enough of them historically, and we're seeing a lot of them now to where it's gone back to making sense that what we do is something that people need. So, and then I would just add by saying, one of the things that is really difficult, I think, for people to get, in which, this is my opinion, which it's not original, is that, I'll just throw this in. I'm not really sure why I'm going to say this, but it feels like it might be appropriate. And that is that from our point of view, since we're craving on these back test sample size, and we have to trade in order to get that sample size, regardless if we're trading 150 or 200 markets, we're going to trade every market the same way. And we're going to trade the longs and shorts the same. And we're going to have very few parameters, entry, exit, stop loss. Okay, something like that. And so then we're left with only one conclusion, and that is every trade has the same expectation because we're pretending that none of these markets have their own personality, and we don't need to know. We can look in the data and see, well, soybeans acted a bit different than the Swiss franc, but we're ignoring all of that because we're saying it's all the same thing. If we don't have this viewpoint, we don't have sample size, and we're just saying it's a market, it's all going to converge over time to the same average trade. The expectation of an outlier is the same in all of them. The longs equal the shorts. My gracious, we know that's not true, but we're going to say this because if we don't have this mentality, it's going to be difficult for us to go forward in confidence with systems with very low sample size.
That's a very good point you raised there, Jerry, because we are specifically targeting these outliers, and these outliers exist in the tails of the distribution of market returns. So they're, 2, 3, 4, 5, 6, up to 10, however many standard deviations away from the mean. We're not targeting the balance of the distribution of market returns, which in our trade sample effectively accounts for 95% of our trades. 5% are actually the result of these outliers that we successfully convert. So when we are talking about the adoption of simple systems and our philosophy, it is specifically because we are targeting these outliers, and each market has the potential to produce these outliers because they're these endogenous events that we can't forecast, we can't predict at all. They just occur with much greater frequency than what a normal distribution implies. We see this in every single liquid market. So we're targeting these anomalies, things that statistically can't be validated. So that's why we're adopting this specific technique. And that's why anyone with a sense of convergence in their mindset is going to be scratching their head saying, what are we talking about? Because they're targeting the unique characteristics of each individual market. They're targeting the patterns that arise historically in a backtest from that individual market. And each of those markets do display different characteristics, but we're not targeting that repeating characteristic. We're targeting those outliers. So our philosophy is couched in totally different terms. And that's why we get so many arguments regarding vol targeting, regarding binary systems versus continuous systems. It's all based on this difference in philosophy that we adopt, where we sit right on the far hand side of the spectrum of trading styles, which is targeting a particular anomaly, as opposed to targeting the balance of the signals that exist in the market data.
And I want to say here that if we ask, I want to add here, if we, for example, ask every person on the street, did you ever seen the price of an instrument or price of something was changed? And almost every person, adequate person, will say yes, of course, price changes. I think every person saw like gold changed, or United States dollars in Russia to ruble, for example, and we all see this evidence, and we apply our unique universal algorithm where we have good money management, risk management rules. We lose a little money, and we have unlimited profit here in this algorithm. And so the price of every market will be changed sooner or later. The second, we use our risk management rules and other rules following the prices, how to follow the price. And third, we use diversification. So I think it's very powerful. Only in these few sentences, I have described a very powerful instrument for catching these outliers.
Another thing we've mentioned a lot is that it's very confusing for people and very anti normal. You know, what smart people do in the markets is that we appreciate. I'm using my word. I'm choosing words very carefully. I appreciate diversification. I like it. I'm happy for it. I trade 200 markets, but sometimes, we get in situations where we realize that, why am I trading crude, heating oil, unleaded, Brent, and gas oil, and all the currencies in Europe and all the currencies in Canada, Aussie, New Zealand, and because they all go the same direction. And then every now and then we get the big outlier from one of them, the yen, or the yen is doing pretty well. And then I made some money in the long China currency as well. So this is a very confusing that at the same time we like diversification. We trade more markets than anyone else and any other group of traders, and we do shorts as a regular basis. No discrimination. Just as likely to be short as we are long. And then we don't worship at the altar of diversification. We worship at the altar of crazy things happen that have never happened before, that are very unlikely, that could create this big outlier, and then we will sacrifice diversification and smoothness to capture that outlier. It may only be heating oil, which has happened to me a couple of times. Big, huge moves in heating oil, and there right now with natural gas. I stayed long natural gas, and look at that chart, and that is so horrific. Trying to stay long that thing because of all the volatility, and if you want to figure out how I trade, I stayed long. So as you know, my parameter is super long term, and it's very uncomfortable. And then the other two natural gas that I trade, Dutch and UK, they stink. They had big open profits and they collapsed. So I sacrificed those open profits in the attempt that there would be another trade that would take off and maybe have an outlier. And right now, as of yesterday afternoon, the U.S. nat gas was doing pretty well.
And I want to add here that I liked when Niels said that we TrendFollowers opened our longs in energies long before global macro guys did this, long before we have seen these fundamental factors.
That's exactly right, and that's because we follow price. So we're using the ultimate indicator effectively just by following price, where we're not making any assumptions regarding a derivative factor that is causing that price movement. We're trading the fundamental signal itself, which is the price. So if markets are trending and we're following price, we will catch those trends. But if the markets are not trending, we won't capture those trends.
Yes, and some guys said that we also use prediction because we think that with very high probability of something get in our side. I think that it's only words here, and we must understand what really means what we do. So the global macro guys, they have, even if we can say that we use some kind of prediction, I don't think so, but it's only words, because global macro guys, they see their own picture, and different global macro guys in the same situation see different picture. And this is the difference, I think. When we do our algorithmic trading, we do follow our rules, and like Nils said, we follow the plan. Whatever happens, we follow the plan, we follow the price. And this is a very big difference, and this is makes us very strong.
Yeah, a lot of people get caught up saying that we do predict, but if we do predict, the only thing we're predicting about is our belief that trends in the market tend to endure. That's as much as it is, as far as an assumption about what the future will hold. We believe that trends will occur and that trends will persist. They'll be enduring in nature. That's all the level of prediction we do, but our systems themselves are specifically simply follow price based on that, what we believe is a universal principle of the markets, as opposed to a predictive notion about what we believe is going to happen tomorrow or what we believe is going to happen next week or next month or whatever.
Yes, market is, like Jerry said, market is a dynamic structure. He was said this about artificial intelligence, and I liked it very much when he said it. Maybe a year ago, maybe 2 years ago, that artificial intelligence strategies, and Nils said that if people use artificial intelligence strategies, then when environment will be changed, the strategy, the fund can be blown up. And the reason of this, that, like Joe said, that such types of algorithms that based only on the past is good for sites of choosing films, selecting films, or maybe brushing our teeth, something static. But the market is a dynamic structure, basic structure, and we use here the basic principles, and as I always say, the principles, the laws of nature. So I'm sure that it's the most powerful thing that we can do, and we have a lot of evidence here, practical evidence and theoretical evidence.
I'm trying to invite people up to be a speaker, so I'm not sure if I'm missing people who are asking to be speakers. So go ahead and, if you want to speak, raise your hand or something, whatever you do on this thing. Since I'm the host, I don't have to ask to speak, so I'm not exactly sure what you guys have to do. But, my son asked me the other day, like, why is Tiger down 40, 50%? Why is ARK down so much? And, he knows the answer because I've told him, you've got to be very careful with your diversification. If you're trading stocks only, if you're not using stop losses, if you're not using trend. I mean, I think that it's a good idea to use stop losses, but as I've said before, if you don't use a stop loss and just use your breakout exit, so you have an entry, breakout, exit, and an exit, you have an entry breakout and exit breakout, then your average loss is probably not going to be too crazy, at least historically. Okay, So, but you've got to commit yourself to these ideas. And that, also went on to say, being long these tech stocks, it kind of gets you in this mode that, look at me, I am a really smart person. And my narrative is really playing out with billions and billions under management and all the markets doing great. And people think so highly of me that I think with me, the trend followers, we just tend to be a tad more conservative and fearful of what can happen. And I wish the best for people like that. I like to see this. I'm happy if stocks have big trends, and I'm happy if they have downtrends. So, and I don't wish bad. I hope these drawdowns don't grow, but we are reminded quite frequently of situations that we could be in if we took a more risky path. And the downside is stocks were great for 10 years, and we didn't do that great, and we underperformed the stock market. But my idea is, I'm always day one trying to preserve that capital, and I'm not going to take the risk associated with concentrating only in stocks and pretty much, buy and hold, or buy until my Jerry's narrative and Jerry's idea of the way the market should work, when that stops.
I want to say that Niels said a few times, very important information to all of us, that stocks didn't perform for 16 years. As I remember, from 1958 to 1974. And this sector had no performance for 16 years and nobody invested in it. But memory of people is very short. And now people see this performance, they invest all their free money in this sector, and I'm sure, and I'm absolutely sure, that it's a big mistake.
Hi, Jerry. Hi, everyone. Glad to be here. Glad to talk to you every week. It's really good indeed. Kind of a busy morning here, but I would just like to chime in this question, this thing about stop loss. I think it's for us trend followers, it's pretty natural to have a stop loss. It's consistent with our methods. When the trend goes against you, then you're out. You're stopped, and it's fine. And when it get backs again, you put on your position, and it's pretty straightforward. For a convergent strategy, I think it's hard to think in these terms, because when the price goes against you, things just got more juicy. If you believe some stock is going up, and then you buy at any price, when it goes down, what you understand from that, from a convergent perspective, is that everything got cheaper for you to get in. So where you put your stop loss, it's really tricky. I think this is so hard for someone at ARK or any of these funds, any of these convergent strategies to grasp, because it goes against their fundamental perspective on investing.
That's exactly right, Bruno, and that's why negative skew gets introduced into convergence strategies, because a successful convergence strategy actually doesn't want to include stops, because, as you say, when you get the maximum adverse excursion, it gets more juicy as things get further and further away from that equilibrium. So they hold on to risk, they warehouse risk. And that's where this negative skew signature unfolds from, when the regime shifts and that equilibrium is now no longer at that location, it's at a different location. But that's where the positive skew of our method comes into play with the use of stops, because even though our small bet sizes are our ultimate form of risk mitigation, the stops are a way of exiting a trade in a portfolio and releasing that risk in a portfolio. So we've got these divergent return streams with positive skew in our portfolio that at a consolidated level lead to fairly extreme positive skew, which is a signature that we don't warehouse risk, we don't hold on to risk, we release risk, because the only way to eliminate risk from a trade is to exit that trade, as opposed to window dressing techniques that hold on, average down, all of these different methods. They're simply transferring risk for a later point in time, as opposed to releasing risk.
And I want to add here that some kind of convergent strategies, they concentrate their risk because they believe in what they predict. And I think if even they have a very good, only theoretically, if they have very good prediction ability, I think that sooner or later it will be big losses. And if we see the real evidence, the real charts, the real track records, we will see it.
Yeah, I really like listening to Rob. He's so funny, and he makes me laugh. And he always likes to mention me, and which I enjoy, And I can't wait for Neil's mention on the podcast that maybe we'll all get together for another joint appearance, and that would be fun. And I listen to these podcasts with Rob and Rich and Mark and everybody, and I could listen to them over and over, and I could be so nitpicky, except for Richard, who he teaches me stuff. But Rob, Rob and Niels, they don't say things exactly the way that I would, but I'm just like, okay, I'm not going to go there. I mean, it's got to pick my places, but they do. They both, Rob especially, he wants to point out this idea that I don't add other strategies to my trend following. Like this is like something bad, and I just don't really get it. I have multiple systems, multiple medium term to long term trend following, and I trade a lot of markets. So I'm doing something to minimize the lumpiness, the volatility, and the lack of smoothness. But adding a negatively skewed convergent strategy to my wonderful trend following. And for what? I mean, number one, I'm going to make less money. I have done the research on this, and we just could never pull the trigger on things that lost money or dramatically underperformed because they weren't catching the outliers. But it made some day or some month less painful. I mean, suck it up or trade smaller. That's always the answer. Trade a bit smaller. That's the one discretionary move that if you want to interject your personality, if you want to try to develop a system that's ease, comfort, and pleasure, no, it's going to be hard. It's difficult. You're going to not like it. But if you're bound and determined to add elements to your system that suit your personality and continue to tell yourself that that's just fine, there's no right answer, well, that's a wrong answer. If you think there's no right answer, especially if you think there's no wrong answers, there's so many more wrong ways to do things in all of life than there are right ways because we're humans. But I am in no way going to feel bad about not trading, not having a long S&P position in my portfolio that has an 8% return and a 50, 60, 70% max drawdown. No, I'll trade stocks, individual stocks, trend following, and pick up those outliers in those markets, but not going to make me feel bad to not add. It's just going against trend following. We're not supposed to care about this volatility on open trades. We're just trying to preserve capital.
I think one thing everybody is probably clear on, or at least I am, is that Jerry needs to keep doing what he's doing. But I want to go back to a really interesting topic that was mentioned earlier on prediction. And Jerry probably remembers Covell and I had a debate about this several years ago. So prediction, has two parts to it. One, when we say prediction, we think of the people on TV, think they're trying to tell you what's going to happen next. Kathy Wood of ARC, they do this predictive stuff on the stocks, and they think they know the future of innovation, and so they literally think that they're predicting what those stocks are going to do in the future. But now, when we're looking at trend systems, we have to have predictive ability, which is predictive power. All trend systems, value, whatever, it has to have some level of predictive power, or else when you enter the position, you would have no expectation for believing it would go up. So in order to have a positive expectation, you actually have to have predictive power in the signals, because predictive power is what creates the end result of having, some positive expectation. So, those are where I think people get confused. I talk a lot about systems having predictive power and predictive ability, because the entry and exit must necessarily have that in order, or otherwise you're just completely random. You have no edge whatsoever. So an edge requires predictive power, but that's not to say the same as somebody who goes on CNBC and tells you what bonds or stocks are going to do, or commodities, in the future. Those are two completely different things. Hope that makes sense.
Totally agree, Mike. Very, very good explanation.
I also agree with this, and I think yes, it's if even we call this a prediction, both of this, it's totally different types of a prediction. And for me personally, I don't call my strategy a prediction strategy. And for me, I believe in my strategy. I know the logic behind my strategy, my trend following strategy. I know the logic behind it. I know I had a big research, I saw a big data, but adding for this a logic, what drives the markets, and understand that it's one of the base principles and one of the base laws, even the base laws of nature, this trending periods, flattish periods. And so when I do the trade, I don't predict what will be with this trade. I only follow my rules, follow the price, and I know that at the end of the day, I will be in a winning situation.
Exactly. And what I'm saying is the entry, the mirror entry signal itself. So say it's a 21-day breakout, the turtle system. That is it's an implicit or explicit, it's an indication that there's some, you're more or less making a prediction. The system is making a prediction that trend's going to continue. So that is a prediction. In kind of like the same way that people say, I think every profitable trader is necessarily a trend follower. How could you not be? If you whether you're buying a stock that's gone down, it has to go up for you to make money. So, you're ultimately, at some point, you're following the trend. You just might have gotten in early and might have gone down 20% first, and then eventually goes up. But ultimately, all systems have to have predictive ability or predictive power. And if you Google those words, by the way, you'll find me on Asymmetry Observations, where I've written about that. But that's just a whole different thing than just trying to say, well, I think this stock's going to go from 50 to 100 or whatever, or some commodity or whatever.
Totally agree, Mike. I think the degree of prediction that we're talking about is very weak. In other words, we're demanding that as a speculator, we must have a positive expectation. Otherwise, we're just trading a random series. So that is all we're talking about in terms of predictive power. We're not, for instance, ascribing any sort of meaning to what's going to be happening in the future. We just know that as a universal principle, there are trends, and as a universal principle, there's mean reversion in the market. There are these principles that historically have stood up to the test of time, that they exist, but the timing of these things, the when, the where, the whatever, as far as prediction, I think is a fool's errand. We just recognize that these principles exist and we trade those principles.
Yeah, exactly. And, I think of it as mathematically. So, for example, back, 20 years ago when I was developing our trend following systems, 2002, 2003-ish, something that, we were taking price trends and breaking them up into quarters and months and scrambling it use a Monte Carlo simulation and feeding that into, I look at a trend system as you have an entry and an exit, doesn't matter what it is. It's something that buys is something that sells. And you're feeding data into it, which is just numbers. And so one of the things where you learn a lot is to see what happens when you scramble that information, you put it into the system and see how it spits it out at the end. And because at the time, what I was running into, I was wanting to trade indexes, and particularly sector and country ETF indexes, and they were really new back then. And so we didn't have a lot of data, but we did have I actually tested on the index data, not the ETF data, because they just didn't go back further than, we're talking 2002, 2003, and these things were literally just coming out. And so I would use the index data. Well, in order to really get a better understanding mathematically, because I'm a math guy, and so a mathematical expectation is my number one. That's why I have the trademark asymmetry. Asymmetry is positive mathematical expectation. Is that we just really want to find the trends and so in order to develop a really robust system, you can break these price trends into all kinds of different parts, and create trends that never existed before in the past, and then you're testing your overall system on data that never even existed before. Okay, so because the system itself could possibly be robust irregardless of the regime and all that. They're always going to have times of where it's hostile or favorable, but ultimately, what I was trying to do is develop systems that didn't really it wasn't just based on a back test of regular data. And so from that, then think about what predictive power means. That means that those signals, entries and exits and all, they have to have predictive power, that somehow that entry and exit is able to extract from a price trend that you don't know how it's going to unfold, but it needs to be able to extract that with a profit and a asymmetric return, positive expectation, and all that. So that's how I see, it's the predictive power of the mathematical system itself.
I was just thinking that a very good way to test the robustness of your strategy is to put it on unseen data. So you can generate the data yourself from embedding a bit of serial correlation into a random return stream. I've done a lot of testing of this as well, and I honestly think that it's as effective as doing back tests on historical data to test the efficacy of the system, by constructing new possible scenarios that history has never seen before. That, to me, is the ultimate form of robustness testing.
By the way, I want to say one interesting for me thing that, in fact, in some interviews with trend followers, great trend followers predicted some situations. So I think that trend followers know more than macro guys how the market is organized. So they have a lot of imagination. Like Neil said, that we have lost our imagination, what can happen. And trend followers understand that a lot of things can happen. So if trend followers had a target to predict, they would do it even better than macro guys. But we trend followers know that it's no much sense in this. It's not the best idea. And I want to say an example that in 2018, Jerry said that interest rates and oil can go negative. And it's great.
So maybe I'll disagree a bit with what Mike Shell said. Mike and our friends we live close to each other in Florida, and he just sent me a picture of his company's hot tub. So he's a good trend follower.
I'm in the hot tub right now.
He's in the hot tub now.
Hot tub time machine?
Yeah. Exactly. So I want maybe just disagree a bit with the way, just semantics maybe. But I don't really look at it in the same way that when we do a trend following trade, that what we're saying is we believe the trend will continue. I definitely don't believe that. Well, and I would not get a lot of credibility from others when I showed them that my chance of that being correct is like 40%. I do think that um, if I did those trades in my portfolio that the system calls for over the next 20, 40, 100 years, I think I would make money. You know, on Friday, we had this horrific close, and all of these Twitter were just going crazy, like, well, this is it. You know, we made this low. It's this horrific minus 900 day on the Dow. Now we know what's coming. Well, we don't. We don't know what's coming on this particular trade. I mean, I don't know what's going to come. More trend does not equal a better or worse situation. It's not foretelling the future. I appreciate more trend, but I don't think I should measure trend, relative strength, and this really great close with the trend to for any sort of information. I mean, I'm long, I'm short from weeks or months or years ago, and I'm happy that I closed out Friday with a good profit. But I'm not. It's not in my brain to sort of think this has any predictive value on this trade. Um, it's just merely looking at 30 or 40 years worth of data historically and saying, if I buy here and sell there, it looks like historically I would have made a decent profit and I could withstand the drawdowns. But it has no predictive and I'm not making any claim that the trend will continue. I have no idea if it's going to continue. I mean, holding on to some of these trades like Nat Gas, which it just crashed. Do you think I was like predicting that it was going to turn around and go back to the highs? No. And I've been in trades before where, you know, we close at all-time highs in some market and I'm making so much money. And then from then on, it's a huge crash down. I'm just left with, I know what I'm going to do. I'm going to get out when my exit gets hit.
Yeah, I'll give you an example of somebody, Jeffrey Woodruff from your neck of the woods, in Virginia. QIM quantitative. They I know that they actually call what they do predictive pattern recognition, and they're about the only ones I could think of. I'm sure that I think Jim Simons and them certainly. Oh well, you know what? Winton actually calls it prediction. I mean, they call it predictive systems, but what they're referring to is not saying, okay, I think the stock market's going to go up from here. Just for random, you know, what they're instead saying is, okay, well, if the SPX goes above the 50-day moving average, I'm going to take a position because, you know, because I believe when it goes above the 50-day moving average, you know, the system shows that, you know, it's going to result in a positive expectation. And it may only be right 40% of the time or even 20% of the time, but ultimately it's going to have an asymmetric risk reward, meaning that by and large, on average, it's going to have a lot more profit than it does loss if we do this 100 times over the next, you know, 20 years kind of thing.
Yeah, Mike, look, Jerry, I tend to agree with Mike here because if you can imagine on any individual trade we take, every signal we generate is because our system has told us that there is a possible trend in action. Now, when we look at our trade distribution of returns, we find that in reality, even though we've got a win rate of maybe 30 to 40%, it's only the 5% of trades that are really material to our P&L. They're the ones with 8R, 10R, 12R, 14R, etc. So that's the 5% of trades. So the signal we are targeting is a very weak signal, but over a very large sample size, it's this positive expectation that's generated over the entire sample size that gives us faith in our models. And that really is a weak form of prediction. We're assuming that these outliers persist in the future. So that 5%, even though we're wrong effectively 95% of the time, when we say we're wrong 95% of the time, what I'm saying is that of the 30 to 40% win, so 100% of our trades are taken because we supposedly have a trend in place that our systems actually activate on. So the system says, here's a possible trend. So 100% of our trades act on that principle. 30% of them are winners. 70% of them are losers. So already 70% of those supposed possible trends are false. So already our predictive ability has gone down to 30% wins. But even within that 30% wins, the bulk, by far the bulk of those wins, so 25% of that 30% is actually just random outcomes of a positive win, as opposed to a small positive loss, a small positive win. It's the 5% that are really significant. That's where our edge resides in these tail events, these outliers, things we can never predict the timing of when and where, but we know from the statistics of very long sample size and the statistics of what academic literature has thrown at us over the last 150 years, that these anomalies persist in the future. So there is a degree of we wouldn't be trading if we didn't have faith in that 5% of outliers, if you know what I mean. But it's a very, very weak edge.
And I want to say here that I think that I had a massive research on the topic about weak and strong signals, and I came to a conclusion there is, for me personally at least, there is no such thing like weak signal or strong signal. So there is no sense for me personally to select signals in such way, because we can, like Jerry says, we can, with some kind of filters, we can filter out ourselves from a big trend, and it will be a very bad situation.
Yeah, I don't disagree with that, Richard. I think we definitely assume that we should stay with the trend. We definitely predict. I definitely predict that. I mean, I'm okay with people. It's kind of like no one ever talks when people get mad at me, or they on Twitter, they'll like try to pin me down. Like it's a semantic argument. Like if I say I don't predict, then they're not interested in discussing, a better word. They just want to prove me that I'm wrong. So I don't really care if I'm predicting or not predicting. I just, in the back of my mind, I think there might be a better word. But I do assume that we're going to get some outliers. Oh, for sure. I do predict that we're going to get enough outliers. Well, I'm certainly putting myself in a situation where I'm not going to be successful. And I have a fair amount of overhead with employees and running the fund, that it would be a major come down if I didn't make money, and my money making is all totally due to capturing these outliers. And so I definitely agree that I am sort of predicting success for myself, and that I'll get enough outliers. It just popped in my head. I wanted just to mention again, how I do research. It's kind of funny because getting back to these 5% of the trades, and so I just one day in my head I just said, well, if it's all about these trades, these outliers, then optimize the system just based on the parameters that are best at capturing the outliers. I mean, there's not that many. Flip through your futures charts and see if the 50-day low gets you out too quickly versus the 100-day low, just with your eyeball. And so I just went through all the big trends, and the Swiss and the crude, and there's not that many of them, and said if I wanted to maximize those 25 trades or 50 trades, whatever it is, what are the best parameters? And that's where I settled on my parameters. And then I told my research crew, take these parameters and tell me if they're good. And they said, yes, they're very good. We ran them over all the data, the 5% outliers and the 95% small winners and losers. And so just by concentrating on what works historically, you're going to be able to back into a pretty good holding period, which I recommend around a year or so, plus or minus a bit. But it's okay. Run it through Excel, run it through TradeStation, run it through trading blocks, whatever. But, my performance has been pretty good recently. And also I have on my side this kind of philosophical idea about how much humans hate holding on to profitable positions, and they get very fearful and afraid that the profit is going to go away, and the computer keeps rewarding. The backtest keeps saying that if you really want to make the most amount of money, try to hold on longer than anyone else.
That's such a good point about just eyeballing. And really that's what we're about. We're saying that most of our time is spent trying to avoid the normal day-to-day market machinations. We only want to sort of involve ourselves with these outlier trades. So when we eyeball a chart, that forces us to step out our lookbacks to longer term. It forces us for each individual system to actually have a very low sample size, but through extensive diversification, that's our way of concentrating the outliers in our portfolio distribution of trade returns. So it all just makes beautiful logical sense. And as Moritz was saying in Clubhouse last week with you, really, you probably don't even need a back test to replace the logic that we embed in the design of our models. I think that's more important. You've got to attack this edge with a design logic before you attempt to do any form of optimization around those core principles of that design.
And I liked your idea a long time ago, which is having this extreme, making it very difficult to enter a trade. I mean, it has to be a major, major breakout, and then maybe not even worried about having multiple entries, but multiple exits. And I thought, yeah, that's a very good idea. I love that idea. Putting yourself in a situation where you're just not paying it, you're just not part of the noise as much as possible. Another thing I've said before, I wanted to bring up again, and that is that, like, how often, putting yourself in a situation where you're unlike other people, you kind of want to be different. And if everyone starts to agree with you, I think it should make you nervous. But how often do we go home on Friday and we're very worried that we got out of this big trade too quickly? Like never. And we're never worried. We're worried about the opposite. Oh my gosh, I've got this big profit built up in crude and soybeans and canola. And what if something bad happens over the weekend on Monday, And so I think that, but the computer backtest says the opposite. And, when I listen to most traders talk about how they trade, I'll just say one thing. They pay no attention to the hints and the evidence that the backtest is telling them. And one way to get around that and be able to claim that you are, in fact, abiding by the clues that you're seeing on the back test is to introduce Sharpe. And if you introduce Sharpe, if you introduce drawdown and volatility as a risk measurement, volatility, standard deviation as a risk measurement, then you're able to do all kinds of bad things that primarily just cutting your profit short. Does Spaces have a place to type in questions like Clubhouse does? I don't see a chat area in Spaces.
I'm a novice in this game of Spaces, Jerry. I wouldn't know. Moritz is here. How are you, Moritz?
Richard, can I ask you something? When you, and for Mike also, when you guys did the experiment, the back test, shuffling the prices, so to speak, which will be, did you add a trend following component to that, or did you end up with totally kind of random time series that didn't have the trend component? And if that was the case, did the system made money or was just a random outcome?
No random time series, but Richard, hi. I'm actually in your neighborhood. I'm tired like a dog, to be honest. I only got here last night. But no random time series to answer that question, at least not for me. I just take the data that the markets give us, and I don't scramble the data in any shape or form. So I don't randomize the returns because that would take It would take the information out of it that I need to rely on. And just listening to you guys on the entries, I have the feeling, I think it's true, that the harder the entry emotionally, the more difficult it is to actually buy the thing. Like, for instance, natural gas. I just a couple of days ago opened another long in natural gas, and it kind of like feels like it's super high at $8. Very hard to buy it there, and it's still the right thing. It's the right decision to buy it there. That is the non-crowded trade, I think. Just do the trade and be ready to pay up top dollars for that long position. See how long it goes. I know where I'm going to get out, so it's not a problem. But maybe it's going to go to $10 or 12 or 14. Who knows? So doing these trades, I think the harder it is to get in, the harder it feels to get in, the better the risk reward usually. It sounds weird, but I think that's true.
And welcome to Australia, Moritz. Now you know sort of the late hours we've got to keep to sort of involve ourselves in these sessions. Look, back to Cordura. There were two methods that I applied to test my trend following models. One was where I randomly generated market data. And the way I did that was, it was a simple test where I went back to, say, the year 2000, and I started at the current price of a particular market like Euro USD in the year 2000. And then what I did was I used a coin flip experiment on the minute time frame where I used a range between 0 and 10. Greater than 5 was an up move and less than 5 was a down move. So that therefore just created a random series, which then I consolidated up to the daily time frame, which involved, say, 1,440 minutes of those individual random time series. And then I traded my trend following models on that random time series. And what I found was that it took about 500 trades or so before I could distinguish whether or not those models actually had an edge in that data. And what we found on when I randomly generated that time series, no matter how many times I randomly generated it, when I looked at trade samples of 5,000, 10,000 trades, they all failed because over that course of time, any edge you actually start seeing over that as your sample size increases. But up to 500 trades, you can have great results for some of your trade results. But inevitably, the negative drag that's from the slippage and all of the assumptions you embed in that, such as your brokerage costs, your holding costs, and your slippage, that deteriorates those random return streams. So that was the first test I did, and that just said to me that no matter what trend following model I applied to that random series, over the long term they all failed, and that was a good sign to me that at least therefore my trend following models must be trading some edge that exists in the market data itself, because the randomly generated time series didn't generate that result.
Just interrupt you. If it worked, that would mean that what is important is the risk management properties of the system, right? But it didn't.
Well, see, I go back to Jez Liberty's tests and also David Harding's conclusions, etc., that even with a random market, you can generate an edge with your trend following models. And I would beg to differ. I'd say that over a particular period of time, such as the 1980s up to the year 2000, yes, that was valid. However, there is so much noise in the market now, I don't think that is valid. So I don't think you can generate an edge off a random series just through money management processes. I think you must have positive expectation, a weak form of positive expectation to generate any form of return from any type of system. But this second test I did was where I said, right, let's look at the real market data. So I got Euro USD back 1,000 on the minute time frame. And then I said, let's now randomize that real market data by taking the information from each of those bars in the minute series. So the difference between the high and the low, the difference between the open and the close, etc. Let's randomly reshuffle that series. So all you're doing is you are reshuffling that real market data to break any form of positive serial correlation that exists in that real market data. So then when I tested that data, that generated data, the randomly shuffled data, I wanted to find out whether the break of that serial correlation was sufficient to make all of my models fail. And yes, they did. Every single one of my trend following models failed when I reshuffled that market data. So that told me a very important clue that there is some serial correlation that exists in the real market data, and that is what gives us our returns for our trend following models. And then I said, well, how much of that serial correlation needs to exist in that real market data to generate the level of returns with compounding that we achieve over very long-term horizons? And I found that when I applied only a very weak form of serial correlation in clusters of very little through that random market data series, on top of that random market data series, I found that that was sufficient to generate this wicked edge that we generate. And that gave me the big conclusion that there is a weak edge that exists in this market data. We can't predict where this serial correlation clusters occur, but they're there. And that's what our models actually get the benefit from. And so that was sufficient for me to actually generate equity curves that were very similar to the real equity curves I generate through my backtesting on real data. So that made me realize that, hey, I can do this. I can actually reconstruct real market data by breaking the serial correlation and inserting it in different locations to generate alternate histories and test my models on it, so that then I could therefore generate different histories to test robustness principles. Like, we've all sort of achieved our maximum drawdown of 30%, but what happens when we get a maximum drawdown of 60%? What happens, do we get those instances arising? And what I found with that process was that I very rarely found drawdowns exceeding that 30% level, simply because the systems we deploy, which cut losses short, means that as we're entering drawdowns, we are exiting our trades from those stops being hit, and the risk is being released. So there is a slowdown in those drawdowns during unfavorable regimes. They don't accelerate like alternate methods. But anyway, it's a long-winded story, Cordura, but hopefully that explains it.
Yes, thanks very much. It was very clear.
Here's how what I talk about is, so look at it this way. Whenever I was randomly putting these things together, is basically partially because we had limited data at the time, because I wanted to run it on ETFs. But look at it this way: if you have a new person, new quant researcher, and you tell them to start back testing and building a system, so you provide them a global universe of 100, 200 markets, 100 markets, whatever, and you say create me a system. Well, obviously we all know what they're going to do. They're going to pick the very best risk reward system, and what we also know, if you've been doing this 20, 30 years, you also know that system is absolutely not going to work in the future. So the better your back test looks, because you're data mining and with perfect hindsight, we know that the future condition is probably not going to be the same, especially at a time like now where we have interest rates and stocks and all these things going different directions. So on the one hand, I like to look at extremes because I focus on asymmetry. So that is, looking at the extreme tails. So on the one hand, the extreme person would go and back test a system and try to make it look as good as they can, so somebody would want to invest in it so they can then pull the money a year later when it doesn't work out. That's the dumb way of doing it. The smart way of doing it is to say, okay, I want this system to be more robust and more applicable across various conditions. So you want to give it a much broader opportunity set. And so to answer the question from before, what I did then and would still do now if I needed to, is literally just take the data and break it into periods, like say 30 days. And so you could take one return stream, break it into 30-day trends, and then scramble and put that back together, and run a Monte Carlo simulation where you've got all kinds of different data streams coming out of that. And there you're trying to develop I'm extremely. I'm kind of a an engineer, I guess, mindset because I like to break what it is I'm doing. So I want to figure out what's going to make this thing break. I'm going to take my car to Sebring and race it on the racetrack. I'm going to make sure of something. I want to find the issues beforehand. And so that's really what I'm talking about is I wanted to. I was always thinking about what could go wrong, and I tell you where I mentally I think where it came from is back 20 years ago when I started testing systems. For 5-10 years before that, I was a chartist, like most of us were in the 90s. I mean, we didn't have all these great programs you have today. It's you're either most of us were getting chart books in the mail. And you're sitting there looking at a chart, and then in between times you check the newspaper. And I would actually plot point and figure charts by hand on graph paper, and did that for a long time. But going back to that level of thinking, we didn't have, or at least where I was, we didn't have it. I mean, up in Chicago, they had some. Richard Dennis and him had ways to test things, but ultimately, it was a chartist. And so a chartist looks at the chart, sees the signal, see that it looks right, gets a good feeling about it, pulls the trigger. The feeling is confidence, by the way. So when you're a chartist, you've got that. You're making the decision ultimately, and it's hard to get past that. And I think that's one of the biggest difficulties, of charting is you really want that control. Whereas when you're truly systematic and more mechanical and automated, it's a very different system. We run both. I have discretionary stock trading that I do, and then options, and then I have my very automated trading systems applied to world markets that are very automated. I don't actually pull the trigger on those. Somebody else does. So so that's kind of where I was coming from. Is I require a very high level of confidence and expectation, which those two go hand in hand. And so I wanted to see what would happen if the past, what will happen if the future does not look anything like the past. So simplicity, think of it if you're just trading just the SPX, which I don't. I actually don't trade SPX. I like to get very granular into the sectors and stocks mostly, or in other markets. But if you were just trading the SPX, you only have so much data, there. So, I wanted to create alternative data streams just to see how it would unfold. And I'll make one more comment, talking about the serial correlation, where, markets tend to, move up or down because they're moving up or down. That's, underreaction to new information. Behavioral finance, has now, I think, done a pretty good job of explaining that a lot of these trends are caused by the overreaction or underreaction to new information. I think trends are primarily an underreaction where it takes time for people to put their money toward their opinions and new information that's coming out. And then you have an overreaction, which is where the counter trend side comes in. The overreaction is when the trend, allegedly moves up too far too fast or moves down too far too fast, where it's overreacted, which yesterday was an example. Clearly, the U.S. stock market overreacted to the Fed's situation in that it was already down a lot. And then it's, when you got a DAS that close, not nearly 4%, then it was an overreaction to the downside, and maybe it's an overreaction to the upside yesterday. But so there you're getting into the theories behind it. Which, by the way, you keep going down that path, and you end up starting to talk more about prediction again, because those theories are, a function of predictive power. So,
Mike, thank you for that, and thanks for bringing me up here, Jerry. I would have asked my question in a chat, but yeah, Twitter doesn't have that feature here. In a past life, for me, about 7 years ago, I would help onboard prime brokerage clients onto the electronic trading platforms, right? So I would go into the CME, the CBOE, ICE, and I would set the limits across different futures exchanges, and also the fat finger limits in Bloomberg across the various trades for prime brokerage clients. In that experience, my question kind of arises related to this design logic to capture outliers. So when you're setting up this design logic to capture outliers, what is the what's the parameter that you set to be able to capture that signal in its full light, right? Like in terms of margin requirements or brokerage requirements or exchange rules, how do you incorporate that to be able to have that into the design logic so that you're not stopped out of the strongest signals at the statistically significant time for you to be able to capture those potential profits that are on the table. That's essentially my question.
Yeah, I don't think it's something to be concerned about. And yeah, we trade pretty small, and with the futures markets, you can, we have a tendency to use about 10 or 20% of the cash, and the rest is just in treasuries. So we don't really, with our trading size or bet size, we're going to risk 20, 30, 40 50 basis points per trade. I use more of a healthy stop loss length. It's not like I'm in and out very quickly on a losing trade even. So that's really not an issue when you get down into the plumbing of how it all works. 99% of the issue is, do you have a good entry and a good exit? Kind of, in my opinion, not too long, not too short term. You want to kind of sit with these trends, and you can see these big trends playing out now. Now is a great time to just eyeball the charts, the currencies, commodities, stocks, and bonds. And some days there are some violent corrections on these trends, and then they go back the next few days and make a new high or a new low. So it won't take you very much analysis to figure out it's sort of a good time frame. Now, the time frame is going to be very painful because sitting through some of these volatility, the right thing to do is a longer term time frame, and of course that's the most painful time frame as well. But I don't think setting up an account and margin, I've never been pushed out of a trade, and I've traded way too large sometimes for my health and for my personality, but I've never had an issue with getting bounced out of a trade due to margin or anything like that. But once you get involved, and then I trade the stocks as well through IB, and I use leverage available through the prime broker. So, it took me some, experience to go from 100% futures to futures plus stocks, but it's not a hard transition.
One of the things, Darren, that in the design logic I approach, so the first thing is I only trade margin products, and the reason I do that is that it allows me to achieve maximum diversification. So if I had unleveraged instruments, I might only be able to invest in 10 of them, but with margin products, I can invest in 100 of them or 150 of them. And therefore, so trading margin products is the first criteria. The second criteria is in capturing these outliers, the definition of an outlier is it's an anomaly. We can never predict in advance how big they're going to be. So the first thing you need to do is have no profit target. That therefore enforces an asymmetry in your system design. And it's essential, as Mike was saying before, asymmetry is an essential requirement for our trend following systems. We want to have cut losses short and let profits run. So no profit target, but we do need some form to exit that outlier. So we use a trailing stop or some form of exit that is quite sort of away from the peak of that trend. So we'll never get the exact end of the trend, and we'll never get the beginning of the trend, but we trade the meat of the trend. In relation to we adopt very simple systems because the nature of these anomalies can be various different forms, from exponential rising trends to very long enduring trends. They can take a staggering number of different types of form. Therefore, we need very simple systems that are not prescriptively designed with many variables to curve fit to a particular desired trajectory. We want to capture a broad range of different trajectories. So the way we do that is through system diversification. So in any market, we'll deploy a myriad of trend following systems, all with different architecture designed to capture possible different trajectories of that outlier. And then the next thing we want to do is say, well, what sort of time frame do we want to trade these things on? And you'll realize through doing your analysis that the nature of these outliers basically, as you step out to longer time frames, you still get the same number of outliers, but the level of noise associated with that trade distribution is far lower. And that's why we go out to the medium to longer term time frames to avoid the whipsaws and mean reversion and signals that exist in the shorter term time frames, to basically distill that signal of the outlier in our portfolio distribution of returns.
I think another thing important to probably, to catch the really big trends. Well, one is you got to be like Jerry, be willing to give up those profits and not think that, that's the market's money. You think that it's, you consider it the market's money, not your money yet until you exit. So you got to be willing to let those profits fade to some extent at least. But I think another thing is, having like my exits are primarily a function of two things. One is the price trend, and two is the volatility. So, if you have some multiple of the average true range or true range, that keeps you out. It keeps your exit outside of the normal noise of the market. Because if you start off with an exit, it's within its normal range of what it's normally been trading in. Say like right now, the ATR percentage of SPX is 1.6% right now. We're looking at 20 days. Well, if you put a stop in at 1%, you're going to get stopped out. If you put it in at 3, you still might. But if you put it in at 3 times, then you're going to give it, say, 5%. To the downside before you would get out. So, obviously the looser the stop point or the exit point, the more you're going to allow that trend to run. And then the other thing there is if you're position sizing it accordingly, as we do in trend following, as a percentage of risk, you're going to have smaller positions. The more the wider your stop or the wider your exit, the wider that percentage, the smaller the position you're going to have. So there again comes why they talk about diversification so much. You want lots of markets because you're taking relatively smaller positions in a whole lot of different markets, and you're giving them room.
Yeah, thanks for that question. And anybody else who wants to ask questions, just don't hesitate to wave your hand or request. I wanted to go back to data. Because you guys talked a lot about data, and I like this data questions. And I don't think I've ever tested data or had any desire to test data that wasn't, historical. And I don't think I've ever tested data when I didn't test it all. I mean, we just tested it all. All the currencies, all the commodities, all the stocks, all the bonds, and I've never done out of sample. And so that's another thing too. Even I will maybe people think I'm hard-headed. I am kind of hard-headed, but I also can be influenced, by other people who continue to say the same thing, and everyone agrees. And I'm like, oh gosh, I wish people would agree with me some more. And so I do feel bad because this in and out of sample, that seems like the right thing to do, but I never thought it was right. I never liked it. I mean, and then I think Bill Eckhart was in an article years ago, and he sort of this subject came up about in and out of sample data, and he was like, "No, I don't use out of sample. You're reducing your sample size. You're on purpose making the back test less data than you have, which I don't think is good. I don't think it's good to overweight recent data, and then you're sort of coming up with this idea that somehow less data is okay. Then you can confirm this less data approach with even less data out of sample somehow. So look, we're all stuck with this idea. I don't think there's any great ways around the idea of we're using data. We hope the future is going to be as profitable as the past. It won't look like the past, but these systems just paying attention to trends and prices and entries and exits in navigating the world historically and in the future that no one can predict, and things happening that have never happened before in the past and in the future that maybe we'll be able to eke out a profit and preserve our capital. But this whole idea of using data to sort of more fine-tune things is something has never appealed to me. And I would just say that I'm obsessed with sample size and more data and using all the data. And I guess that definitely assumes that the markets, that's good data, and it hasn't really changed very much. And as the markets change and evolve, I'm kind of ignoring that to a degree. Although at one point in the late 90s, I did decide that longer term was better. And I could definitely see in the future, possibly adding systems that were longer term or shorter term. I don't know. But yeah, that's my speech on data.
I read that Bill Eckhart article as well, Jerry, and he said data is far too valuable to use some of it for out of sample. He said use all of it, and I tend to agree. But with convergence strategies, you do need to preserve out of sample data, but with divergence strategies, you don't. And the reason is this. With convergence strategies, you are looking at a repeatable condition when you design your system. So you data mine for this repeatable condition. Once you've found that repeatable condition over the data set, you want to test in out of sample that it wasn't a random repeatable condition, and you therefore need to preserve out of sample data to ensure that your strategy was not overfit for that historical data to randomness and was fit to signal. So therefore the out of sample component is a necessary requirement for convergence strategies to test that repeating condition persists into the future. But for a divergent strategy or trend following strategies, once again, the corollary exists, the antithesis. We don't need out of sample data because our design logic embeds embeds the constraints that our system can operate in with our initial stop, our trailing stop, and our open-ended profits. So we want as much data as we can to basically validate our robustness. In other words, we're looking for strategy weakness in our backtest, and we need to use all of that data. Because we're not looking at how that strategy will perform in the future. We're looking at the weakness of that strategy, or what are the weak points in relation to what history is presented. And therefore you need to use all of that data for that, because we know that the design of our models actually capture this asymmetry because we designed them that way, as opposed to convergent models which are targeting an equilibrium which changes with regime shifts. And therefore it's a different ballgame totally, where you do need to preserve some of your data as out of sample to ensure that regime has not changed.
Exactly. And I've never had the desire to see how new data would look. Hey, here's some new data. I'm adding markets all the time. Stocks, that add diversification to my portfolio. And then I add these ETFs and stock indices I've never traded before. I short indices in the stock sector and ETFs in the stock sector, and I go long the individual names. And so I've never crossed my mind to say, hey, check out how this does. No, why would I want to do that? Each market trade has the same expectation. They're all the same. I would just say to myself, oh, I did test it, and this data is wonderful. What am I going to do with that? They've had a lot of good trends in this new set of data I picked up. So how's it going to change my mind? I hope it doesn't change my mind at all. Or the opposite. It's bad. So, then I'm not going to include those markets. No, I'm going to include those markets. I don't care what history says about those markets. They're great markets. Some of the stocks I added that made a lot of money for me over the past few years, I added strictly due to diversification properties, and they had never made money before. And then all of a sudden, I got lucky, and some of them had some major outliers.
Yeah, and I agree with what Jerry said earlier, talking about the fine tuning. When I hear fine tuning of a system, that's always a concern because, of course, everything is relative. But when I hear fine tuning, it sounds like curve fitting and trying to zero in on too much. You don't want to fine tune yourself. If you fine tune a system too much, then trends that system has never endured before, is probably not going to know what to do per se. But as far as testing lots of different markets, or maybe even creating some that don't even exist by playing with the data, scrambling it, whatever, sampling. That's really intellectual curiosity. For me, it was just curious of what would happen, if I applied these same systems across different return streams.
Jerry, thank you for holding spaces like this for anyone to listen to. I was wondering if anyone might be able to comment on. I hear a lot about trend following systems with breakouts and establishing positions. Mostly, everyone references long positions, and I'm wondering if anyone might be able to comment on how they think about establishing their short positions, since it is both a long and short system that you're utilizing.
I don't want to hog the mic, but I think the entry for the long would be the same for the short. So if it's a 100-day breakout to go long, it's a 100-day breakout to go short. If it's a 50-day breakout to exit the long, it's a 50-day breakout to exit the short. So that's the key there, the symmetry between those entries and exits, and they're the same parameters. So when we do the back test, we can count all those trades as evidence of when we go to choose a system, we have enough historical trade samples that we feel good about it. And, we've tricked the computer. We, as Richard said, like 5% of these trades really matter. We like the other trades because of the diversification properties, but really we're making money from such a small, so we're not segregating the trades based upon the profit. We're segregating them based upon the entry and the exit, which they all have the same. So in our net, where we're pulling in these fish, where most of these fish are not keepers, the net also includes all of them large. I just went fishing, obviously. All of these large fish that are really making all of our money. And so if we trade the entry, the longs and the shorts the same, and all the markets the same, then we have accumulated this trade evidence for the future, and that is the key to all trading. There's nothing more important. Almost every question has the same answer, or the same question, the same follow-up is, okay, good idea, but what's the sample size? How does that impact the sample size? Because without that, and I'll say one thing, it is the least asked question. I mean, it's not that sexy. You talk about a narrative in trend followers and system. People have no narrative. I mean, my gracious. Then I'm going to sit up there, and in something so boring as talking about technical trend following, I'm going to bring up the most boring aspect of it. Yeah, no one's interested in that. Tell me another turtle story.
One of the things we've got to keep in mind as well is that the reason we trade both long and short is not necessarily because shorts are more profitable than longs. Actually, I find that in general, my long trades tend to do better. But the reason we do it is at the portfolio level, those short trades give you great correlation offsets to sort of, I hate to say this, but to reduce the drawdowns of your overall portfolio. Now, I know we keep away from this term smooth portfolio, but certainly by including shorts in our portfolio, the correlation offsets do really assist.
Very good point, and I think that we want to stay away from smoothness and sharp and volatility unless it's diversification, unless it's multiple systems that have the same large sample size, and we're trading. I have 4 systems. I trade 25% of the money of my capital with each system, but they're very similar except the time frame. And so, yes, to the degree that I trade 200 markets, that's acceptable smoothness. Whatever smoothness I get, shorts, wonderful. You know, they're going to make less money. Close your eyes. Do not look at shorts versus longs. Add all the trades together. That's what you're getting. The expectation of all the trades, longs and shorts. Don't be tempted to segregate out, well, I can make this much better by doing fewer shorts or no shorts. It's the other stuff, cutting profits short, paying attention to volatility, optimizing the system with too many entries, with too many variables and parameters, and paying attention to volatility and taking smaller profits than you should. These are unacceptable ways, non-robust ways to minimize vol.
I like these ideas very much, appreciate this really, and I think that when some guys say that it's okay to combine trend following with some convergence strategies, and I always say that it's much better idea to, and we have speak about today about this topic, a much better idea to add more markets. And maybe if you have very big amount of money, you can add more time frames, more exits and enters, and it's the best idea. Then add different complex strategies, do your strategy more complex, less robust, and less effective.
I've been in the hot tub now for about 2 hours, so I better get out.
You know, I remember when I first went, to Chicago, and I met Rich, and they definitely would say things like, I've never had a real job, and I don't want to have one, and you guys need to follow our rules and understand how we trade, or you're going to go back to having a real job. So that's number one. And then number two is there's just so much evidence that with the strategy of trading, that it's not going to be instantaneous. You're going to have to gather AUM, take some lumps, and learn over time and lose some money. But there's just nothing better from a lifestyle or from a competitive point of view. You'll make some mistakes, but it'll be not following your system. You can overcome that. It'll be trading too large, right? And you can overcome that. You have to feel your way around. I mean, they used to always say, trade it really, really small. No one starts out trading small enough for whatever reason. So, but are you going to lose half of your money because you're concentrated in one sector? No. Are you going to lose half your money because you're still long after the market has made a significant low? No. You're not going to make the things that everyone else that has way more money and education and talent and people than we all have. No, you can compete against these people and win, because winning is just surviving, for a long period of time. Oh, yeah, somebody tweeted, I saw it this morning, like, well, I can't argue with Jerry because he's been around so long. I mean, to some degree, Richard's brought this up, these long-term track records of people, and not just me, it's other people too, Dunn and some of the other people out there who've just been around forever, continuing to, trade trend, pay attention to price, and diversify. Really, it's not going to get any better than that. They've survived. And so many people with better Sharpe ratios, they end up not surviving nearly as long. So anyways, with that said, I will, unless someone has one more question, we got 8 more minutes. Raise your hand, or we'll declare this a success and maybe probably be back on Spaces next week. And the recording happened this time. So it'll be out there, and then Richard's going to put the recording on his website as well, hopefully. One more question. Anybody going to raise their hand? Okay. It's been fun. Hope everybody has a good weekend, and we'll see you next week. Back on Friday. More travel for me tomorrow, so I think we'll be back on Spaces plan on it next week. 8 Eastern time. Have a good weekend, everyone. Thanks for everybody for being here. Thanks, Mike.
Thanks, Jerry. Thanks, Mike. Thanks, everyone.
Thanks, everyone. Bye.
Thanks.